Self-directed IRA is not a new retirement account. In fact, when IRAs were created back in the 1970s with the advent of ERISA and became popular in the 1981 Economic Recovery Tax Act, which really opened up IRAs for all employers and employees and added over $2,000 of contribution limits, the whole idea of a self-directed IRA came into play. The tax code always allowed individuals to use their retirement accounts to do pretty much anything other than three things: life insurance, collectibles, and what's called self-dealing transactions under 4975. So anything else can be done, whether it's stocks, real estate, precious metals, it's allowed. However, the whole idea of what is a self-directed IRA is something that's more of a marketing ploy than anything else. So there's really, I like to break it down into three types of self-directed IRAs. So if you go to your local bank, whether it's Bank of America, Chase, Wells Fargo, or Fidelity, and say, hey, I want to open a self-directed IRA, they're going to say, no problem. We offer self-directed IRAs. Our self-directed IRAs are great. Come open one up. It's free. But really, in essence, what is it? So yes, it's self-directed because, yes, you can decide if you're going to buy mutual fund A, mutual fund B, mutual fund C. So in essence, yeah, it is somewhat self-directed, but every IRA is self-directed. We don't have a system where the government requires you to buy treasury bills, for example, or stock X with all your retirement money. That doesn't exist in our system. Hopefully it never will. The whole idea of retirement account savings is you have some control over what you invest. Clearly the prohibited transaction rules, which I'll get into in detail in a separate video, limits you to some degree in what you can and cannot do, but otherwise you can do it. So every IRA is in essence self-directed. So getting back to our first category of self-directed IRAs, and I call it financial institution, traditional self-directed IRA, you can get one for free, whether it's Wells Fargo, Bank of America, they'll open one up, no problem. But you are limited to investing in what they sell, whether it's mutual funds, ETFs, stocks, treasury bills, bonds. They're going to only sell you what they make money on. And that's their prerogative. It's their right. If I ran Wells Fargo, I wouldn't allow my clients to buy real estate or precious metals or cryptos. I would let them and require them to buy the products I sell. Why? Because I'm in the business of making money. That's my goal. Generate revenues by selling products, earning commissions or fees from financial products. So you're not going to be able to buy real estate or do anything alternative in a traditional self-directed IRA at a bank like Wells Fargo. It's just not going to happen. Doesn't mean you can't do it. They're just not going to let you do it. Why? Again, because they don't make money when you buy real estate. They make money when you keep the money in their institution and use it to buy the products they sell. So most people kind of stop there. Why? Not because they don't want to buy real estate or tax liens or precious metals or cryptocurrencies or invest in private businesses with their IRA. The problem is they don't even know the option exists. No one's told them that you can buy real estate with your IRA, for example. Again, why? Because the institutions with the money, the banks, don't want to advertise the fact that you can use your IRA to buy real estate or precious metals or cryptocurrencies or tax liens. They don't make money when you take the money out of their institution and buy real estate with it. That doesn't help them. So why would they advertise it and spend millions and millions of dollars on TV, radio, social media ads to tell you, hey, Joe, you have a self-directed IRA with us, but you have options. Why don't you take your money out of our institution and buy real estate with it, or buy precious metals, or buy cryptocurrencies, or invest in hedge funds or private equity funds? They're not going to tell you that, and I don't blame them. But in fact, there are alternatives to just traditional self-directed IRAs if you want to have that option. Now, there's over 50 million IRAs out there. $50 trillion in IRA, 50 million, it's over $7 trillion in IRA funds, close to $8 trillion actually. A lot of people. Not everyone wants to do alternative assets. Most of the 50 million IRAs probably are happy buying stocks, mutual funds, ETFs, exchange traded funds, and that's fine. But the IRS, under Section 408 and 4975, has given us the options to do other things as well. And that's where the second two categories of self-directed IRAs come into play. The second category of self-directed IRA I like to call custodian-controlled self-directed IRA. Basically, it is a structure that allows you to do alternative assets like real estate and also traditional assets like stocks, just like you would at Wells Fargo, because the custodian-controlled self-directed IRA is a different business model than Bank of America or Wells Fargo or Schwab. Custodian-controlled self-directed IRAs, like IRA Financial Trust Company, does not make money from the products you buy. They don't make money if you buy real estate. They don't make money if you buy Apple or Google or IBM or GE or Ford or Mutual Fund X or ETF Y. They don't care. As long as it's not prohibited, they'll let you do it. And they generally make fees and earn fees by you opening an account, doing transactions, like buying real estate, selling the real estate, collecting rent payments, paying taxes. Anything the custodian has to be more involved in and help you do so. Why? Because in the custodian-controlled self-directed IRA, the custodian's involved. So let me give you an example. Adam Bergman has $100,000 in an IRA, and I want to buy real estate in Texas. So I have an account at Vanguard. Unfortunately, I know now they're not going to let me buy real estate with my IRA, even though it's allowed under Internal Revenue Code Section 4975. So I do some searching online, and I find IRA Financial Trust Company who says, hey, you want to open an account? No problem. You want to buy real estate? Great, we'll help you do so. So I ask, how do you do that? So it's pretty simple. It's really 3 steps. First is you would open an account at an IRA custodian. And generally, IRA custodians, unlike Wells Fargo, they're not banks. They are institutions that are allowed by law, generally under state law, to serve as a trust company to administer IRAs and 401ks. So under Section 408 of the Internal Revenue Code, 408 basically describes who can open IRAs. So generally, it's a bank or financial institution and a trust company authorized under state law to administer IRAs or a third party, sometimes an attorney. But basically, you need the authority to do so. You can't open an IRA at Walmart, or you can't open an IRA at Ruby Tuesdays. You need to have an institution that will allow you to open the IRA that's authorized to do so. So there's plenty of really, really formidable, solid, reputable companies like IRA Financial Trust that will let you open a IRA there. Generally, they'll use a bank, like we use Northern Trust as our bank, so you get FDIC insurance up to the $250,000 of cash held at the custodian. But once you roll your money into that new self-directed IRA that was established, all you need to do is really provide the custodian with the documentation they need to sign in order to allow you to execute that transaction, whether it's real estate transaction documents, whether it's any other types of transaction documents that will allow your IRA to purchase the asset. Once you purchase that asset, the custodian will essentially wire the money, let's say, to the seller of the property. The funds will go from the custodian to the seller of the property. Title, for example, would be IRA Financial Trust Company, CFBO, custodian, for the benefit of Adam Bergman IRA. And then the IRA will own the property. The rent, the gains, hopefully, will go back to my IRA without tax. And here, this strategy has allowed me to buy alternative assets like real estate in a tax-deferred IRA. And that, again, that's the beauty of a self-directed IRA. You're not paying tax when you're rolling the money into the IRA, and you're not paying tax when you generate income or gains from the IRA investment. You're deferring the tax, or in the case of a Roth, you're exempting yourself from tax until you take a distribution. So that's the second category. To recap, the first category, the traditional self-directed IRA, you can go to any bank, and really you're just limited to the products they offer, like stocks, mutual funds. Second category, custodian-controlled self-directed IRA, lets you buy real estate, precious metals, tax liens, private equity, hedge funds, private business investments. And that is the custodian, so it lets you do alternative asset investments and also traditional investments if you want to open a brokerage account. But you need to get the custodian to do it for you. So everything needs to go through the custodian. Custodian's kind of the conduit that money needs to go in and come out through in order for you to do your transaction, which does trigger fees. There are fees for transactions. And there are sometimes delays because the custodian has a lot of clients and is busy, and you can't always get your transaction done or your check written that day. So if you have a handyman that you need to pay, or a plumber to fix up your repair your property that's owned by your IRA, that person may have to wait 2, 3, 4 days to get that check. So it has some negatives too, but again, the positive is you are able to buy alternative assets. The costs are not super expensive, and you have the ability to diversify your retirement portfolio. But that has created the third category of self-directed IRAs, also known as checkbook control or IRA LLC. And really the whole point of it is it uses an LLC as the conduit between the custodian and the investment. So it basically sticks an LLC in between the custodian and the investment. So basically, once you send your IRA money to the custodian will fund a newly established LLC. And for people who don't know what an LLC is, it's a limited liability company. You can open in all states. It's treated for tax purposes as a pass-through entity. There's no entity-level tax. And the beauty of the LLC is you do have limited liability protection. And once the LLC has income or gains, the owner of the LLC is responsible for the tax. But here we know an IRA doesn't pay tax, right? An IRA is exempt from tax under Section 408, just like a 401k, just pretty much like a charity. So you have an LLC that buys real estate. The income or gains will flow back through the LLC like a funnel into the owner. The owner is an IRA, and the IRA doesn't pay tax. So that's the win-win with the LLC, is it gives you that limited liability protection to protect your IRA against creditors, and also it gives you a very tax advantageous method of using retirement money to make investments. So that's a really, really super exciting part of the checkbook control. Also, think about this. The LLC now has your cash, right? So you roll your $100,000 to IRA Financial Trust. Instead of IRA Financial Trust and sending that money to the asset or to the seller of the real estate like I did in the second custodian controlled example or category, now it's being sent to the LLC. So Adam Bergman would go to Chase, Wells Fargo, open my LLC account. Let's say I called my LLC Adam Bergman LLC. I would go to the bank. I would open my account. I would provide the custodian, IRA Financial Trust, for example, with the LLC bank account info. They'd wire the funds tax-free to the LLC. I'd be the manager, and as per the operating agreement that I had generated, the manager has the control over the operations of the LLC. The manager will write a check or do a wire to the investment. The money will then be sent to the seller. Title will be in the name of the LLC. And basically what I've done is I've taken a lot of the responsibility and day-to-day operations of the transaction from the custodian to the LLC. I'm going to save time. I'm going to save costs because I'm doing more as a manager. I'm still not doing prohibited transactions, and I'll get into that in a different video. I'm still not able to break the law, but it's allowed me to reduce my costs. It's allowed me to reduce the time I need to help administer my transaction, and it's given me just a little bit more passive control over the activities of my assets in the LLC. So the checkbook control is on one side of the spectrum, and the traditional self-directed IRA is on the other. The custodian-controlled self-directed IRA is kind of in the middle. The traditional self-directed IRA is great if you just want to buy stocks and mutual funds. You don't need a checkbook control or a custodian-controlled self-directed IRA to do so. Just do it through a local bank. It's easier, cheaper. You'll be fine. You want to do real estate, and you're going to have a lot of transactions like flipping. The checkbook control is a good option probably. If you want to just hold it, like land, custodian-controlled is a good option. If you're doing private equity, hedge fund stuff, venture capital, where there's holdups, meaning you invest the money, it sits there for 1, 2, 3, 4, 5 years. Custodian control model really works well because you don't need the transaction. You don't need more control over the process. But if you're doing flips, if you're doing cryptos where you actually need to hold a wallet, the private key, if you're doing precious metals, tax liens, most transactions with your IRA that involved more volume, more activity, checkbook control is probably going to be more cost effective and probably going to be a lot more easy to operate because of the fact that you as the manager of the LLC have so much more control. So that's really what a self-directed IRA is. It's not a term of art. You're not going to see the word self-directed IRA anywhere in the tax code. It doesn't exist. You'll see the word IRA in Section 408, 4975, for example, 408. You won't find the word self-directed IRA. It's made up. You can call it anything you want. But basically, I like to break it down into 3 categories: the traditional, the custodian-controlled, and the checkbook. If you're doing traditional investments, traditional self-directed IRA works. You're doing real estate, number 2 or 3 work. Depends how much activity you need, how much control. If you're going to do a lot of activity, a lot of transactions, check out the checkbook control. It could be a very good option for you. It's more hold. Number 2 could be a really good option, the custodian-controlled, because you don't need the amount of, you don't need the LLC and the cost, and you probably don't need the control. So that's really what a self-directed IRA is. I think it's really important to understand your options if you're looking at self-directed IRAs. Understand what you want, what you're comfortable investing in. Again, the IRS lets you do pretty much everything except three things: life insurance, collectibles, and self-dealing. So the world's your oyster. You can decide what you want to do. You're not forced by mutual funds or treasury bills or bonds or stocks. You can do everything you want. Essentially, just keep in mind the prohibited transactions I mentioned and the exempt categories, and you can do it. So just obviously think about what you want to do, understand your options, and the self-directed IRA could prove to be an extremely valuable retirement vehicle for you. Number one, you take advantage of tax deferral or tax-free growth. If you have a Roth, your money grows without tax. Let your money work for you without paying tax. As a tax attorney, it's one of the first things you learn about in school. And as a lawyer, you defer tax or you don't want to pay it. You do whatever you can to minimize tax or defer it or exempt yourself from it. So the IRA, and especially the self-directed IRA, is really a valuable retirement vehicle. We're lucky as Americans to have it. Anyone with earned income should try to take advantage of it, max out, contribute, be consistent, and just trust the process. Let it work for you. Your money will work for you. Whether you're buying real estate, stocks, mutual funds, not so important. Just contribute, start early, and invest in what you're comfortable with and what you feel will give you the best chance of having a large retirement nest egg when you're ready to retire.